Well, it is appealing to us because we're looking for larger addressable markets. If you've got a great customer value proposition in a business, what you need to really grow that business is a larger addressable market than exists in Australia. Once again, you've got to do your homework and make sure that the market that you're expanding to is similar to the Australian market and able to be exploited in the same way the Australian market is. But it's ended up in a situation where out of 21 stocks in our Australian equity portfolio, there's only 3 that don't actually derive their income offshore. So the majority, in fact the vast majority of companies we have actually deliver most of their revenue offshore. So more than 55% of the revenue of our Australian Growth Companies Fund is actually derived globally. And they're businesses that have done very well in Australia, and they're now developing those businesses in offshore markets, whether it's REA, who are building a business through a minority holding in the USA, Seek in Asia and China, Iris in the UK, Canada, South Africa. I mean, I just go through our whole portfolio, but that's how we see it, is that these are opportunities for companies who have great customer value propositions to actually be able to deliver that to a wider addressable market and obviously have growth options. So Domino's Pizza is a classic example of a terrific customer value proposition that is convenience and price, which are the 2 things that really drive people, and the third is choice. And they've been able to deliver that well in Australia and continue growing their business in Australia, both through store numbers and same-store sales growth. But they're also now doing it in Europe and Japan, and other places in the future. And we see that as a 5 to 10 year growth path for a company like that. Well, we look for a specific type of growth offshore. So we don't like massive acquisitions, and a lot of the businesses that you refer to spent a lot of capital to get started. That's the first thing. The second thing is they were businesses like building companies that took a good idea here in Australia to the US, which is one of the most mature building markets in the world. So we're looking for businesses that are disruptors that can get a first mover advantage in something. And so, even REA sold its Italian business because it wasn't the first mover. They're clever enough to understand that you've got to have a market that you can do well in. The second part of that actually refers to the opposite of what I just discussed, and that is they're capital light businesses. It doesn't cost them a lot to actually build the beachhead overseas. Sometimes, like Seek, they'll go in as a minority holding and they'll build up that holding as they deliver intellectual property to the company overseas, and as they gain confidence in that market, and they'll use a local player to gain those local player advantages. But in each case, we look at which company is doing it, and we assess each company on their likely prospects of succeeding. And so we just don't take a one-size-fits-all to globalisation. So it doesn't always work for everybody. And of course, the key issue we're always looking for is the level of global competition. And of course, as we might discuss, in the global sphere, there are some very big, mean competitors.